Welcome to the Expansive CEO podcast. I'm your host, Hannah Chapman, founder of Expansive CEO and X Squared Wealth Planning. Buckle in as we explore how to create true prosperity and build a business and a life that expands beyond yourself and makes a dent in the universe. Hello, everyone. Welcome to this Financial Friday episode of Expansive CEO podcast. This is recording on June 15th, 2023 for June 16th, 2023 release. And I am here as usual with Brad Haines, the Chief Investment Officer of Juncture Wealth Strategies, Chartered Financial Analyst, CFA, and Financial Risk Manager, FRM. Brad, thank you for being here. What are we talking about today?
Thanks for having us. We are talking about so much, Hannah. It has been a very exciting week. Just yesterday, we had the latest Federal Reserve meeting where the Federal Open Market Committee, that committee sets interest rate policy for the United States and for much of the world who happen to tie their currencies to ours. And so that meeting just took place. They paused interest rates. What does that mean? It means they're not going to increase interest rates. But in his commentary, in his press conference right after, the chairman of that committee, Jay Powell, said, well, we're pausing, but. And that but got everybody a little nervous. Yesterday at the time he started speaking, the S&P 500 was actually up quite a bit. And then during his, when they hear that but, all of a sudden it starts selling off, and we was down about 1% during his press conference. And then by the end of the day, everybody kind of let the panic subside, and we ended break even on the day. So I want to talk a lot about the Federal Reserve and what Jerome Powell's comments actually mean. But to set the stage, I want to talk about one of the tools the Federal Reserve has is called moral suasion. And that sounds like a very weird term, and it is. But what it means is it's the Federal Open Market Committee members trying to convince investors and households and consumers and businesses to act a certain way. And so when Jerome Powell comes out and says, but we might be increasing interest rates another 2 times this year, what does that do? Well, he's trying to use moral suasion to convince us that, hey, the cost of funds, our interest rates are going up. So what does that do? That makes business owners start to step back and go, okay, maybe we should wait on doing that next investment. Maybe we shouldn't expand right now. Maybe we need to batten down the hatches a little bit. He's talking to the household. The leaders of those households are saying, maybe vacation, we should trim back just a little bit this summer so that, again, so what that does is it restrains economic activity. What does a restraining of economic activity do? Well, it has a downward pressure on inflation. And so inflation then starts to, again, decline at a more rapid clip. Unfortunately, I think a lot of investors figured out that he was just trying to persuade people to act a certain way. And that's why today we're up pretty strong. The S&P 500, as we're sitting here today, it's about, halfway through the day, and we're up about 1% on the S&P 500. The NASDAQ's up, the Dow is crushing it, and oil's up about 4%. So again, moral suasion is it's a difficult thing to do because people can kind of see through his reasoning and act accordingly, which means invest for a lot of people today.
Yeah. So when we were talking about this earlier in the week, what you were saying was that, yes, we paused. That's what they came out. They did not. A pause means they did not raise interest rates again. And remind me, how many times or for how long, how many months have they been raising interest rates at this point? Do you know?
For about 18 months.
Okay. So every time they've met, they've gone up. and up and up and up for the last 18 months. And so what has been happening in the markets is every single time they've come out with an interest rate hike, the markets have done a downdraft pretty much every single time if we go back and look at the statistics. And so what we have been waiting to hear, we're going to pause. We are not raising interest rates this time. And that's what we got yesterday from Jerome Powell. And the little asterisk that you put on it was that, but we may raise interest rates 1 or 2 more times through the year. So that piece of it, there is a reason, right, why he said that, though, because the interest rates are tied to inflation, or the interest rates are the tool used to control inflation, right? So
to combat it, yes.
Yeah. So tell us what inflation is doing right now.
So inflation has been declining since June of 2022. It reached such a high level that it's taking some time to come back down to earth. So it peaked a little under 10%, a little over 9%, however you want to look at it. And it has been declining pretty rapidly ever since, or it's been declining pretty consistently ever since. But again, the target range for the Fed, or what they would consider acceptable, is in 2% range. So even though, we're 9 to 10% and we've come down a lot, we're still 4 to 5% range, depending on the measure you're looking at. And that's still twice the level that they would really like to see the inflation rate be at, or the level of the inflation rate. So they're still, again, very concerned about inflation, about how that's impacting households, how that's impacting the spending of the lower economic classes, because that is a very painful event to have happen when you're working, you're coming along, and all of a sudden your bills spike up by 10% a year, and your income doesn't spike up by 10% a year. That can be really difficult on a lot of families. So the Federal Open Market Committee is very concerned about how that regressive nature of inflation is affecting the families in the United States. And so that's why they're being very, very hawkish or combative on inflation at this point.
You just said 2 terms that I want to explain just a little bit, because I think they're really good. Regressive being one. And so for people who maybe hear that term but don't know what that means, what does it mean when something is regressive, when a policy is regressive?
It means that the lower economic classes pay the bigger part of it. They pay the burden of it. They pay a higher proportion of it. And so, for example, inflation at 10% or 5% to 10%, it may not impact a billionaire the same way as 2 people that are existing on minimum wage. Okay. The billionaire clearly has excess income, excess assets to pay those increased costs. So it's not necessarily as impactful on those individuals. Whereas that household of, kind of living paycheck to paycheck, when all of a sudden food prices go up by 12% in 1 year, that is really, really impactful. I mean, what do you do if you don't have savings to draw from? Well, oftentimes they start to cut back their expenses, and unfortunately they may have to cut back on things that are actually necessary for living. And so that is why it's a regressive in that manner.
Right. Yeah. So that I know people hear that term frequently, and I just want to make sure that we talk about what that actually means. And when we talk about something being regressive, tax policy, for example, we're talking about who that impacts the most. The other demographic that came to mind was seniors living on Social Security, that kind of thing. Anyone with a limited income in some way, shape, or form. And this podcast being mainly for entrepreneurs and business owners, we need to know that as well, right? Because when things are affecting the people who can then pay for your goods or services, like that's important for us to
Yeah. Well,
Keep
and
in mind.
a lot of business owners have been hit twice. Not only have their personal bills gone up, which hopefully they can handle it because hopefully they have excess cash flow being generated out of the business, but also their employees.
Mhm.
Their employees are being hit by that. And so they might have requests from their employees. Hey, boss, can I have a little bit of an income increase? Can I get a bump? Can I get a raise just to help offset some of these higher costs of living, the higher cost of living? And so, you know, business owners are getting hit from two sides. Not only are, the revenues maybe more struggling from their customers, but also from their employees might be struggling to keep pace with that cost of inflation increase.
So interesting. And important, just important to keep the human centered, right, in this conversation. Like, who are we actually talking about? And I said two things and I completely forgot the second one as you were explaining. So if it comes back to mind, we'll talk about it.
Hawkish.
Hawkish. That was the other one. Yes.
Okay.
Yes. What does that mean when the Fed is being hawkish? Because we've got hawkish and dovish, right? Those are
Yes.
the two terms. So when people hear that, what do those two things mean?
So, for whatever reason, the financial markets like to have different symbols of events. The bull and bear market,
Yeah, we'll talk about
hawkish
that too.
versus dovish. Yes, we will. Hawkish versus dovish. So, if people think of a hawk, what does a hawk do? Well, it's a predator. It takes things out. You're going to fight. They're going to fight. They're going to be aggressive towards something. Generally, the hawk is aggressive towards a prey, or in this case, a dove. Okay. Um, and so, what it means when the Federal Reserve is being hawkish is they're being more combative. They're going to be more aggressive in fighting inflation, which means what? They may increase interest rates further. They may shrink their balance sheet at a more rapid rate, or at least continue to at the current rapid rate that they're having it draw off. Um, if we say they're dovish, it means they're not necessarily concerned. Doves, when you see them walking around, they're pretty content just to find stuff on the ground to eat or to kind of bug you a little bit, but they're really pretty just chilled out until they see a hawk. And so, again, the dovish, you're kind of chilled out. You're not necessarily worried about anything too much. A hawk, you're very, very worried about your next meal. So those are the terms that we would use when describing the Federal Reserve's policies. If they're being aggressive towards inflation, it's going to be hawkish. If they're not necessarily concerned about inflation, they're going to be dovish. So those are the two descriptors.
Love that. Thank you. Thank you
You're
for
welcome.
reminding me of reading my mind, what I wanted to expand on. And it leads perfectly into one of the things we wanted to talk about today, which is it was actually a question from one of my clients who said, "Hey, I heard we're officially in bull market territory at this point. Is that true?" And we talked about that a little. You and I talked about that a little bit this week as well. And what does that mean? Because we've had different parts of the economy increasing at different rates. And so when we talk about, are we back in a bull market? What are we actually asking about? What does that mean? And, yeah, what are bulls and what are bears and why? All good questions.
Okay. So let me start by talking about why we describe them as bull and bear markets, and then I'm going to transition into, are we in a bull market, and answer that question and kind of go down that path. First of all, like I said, we like to have a lot of symbols in our industry. So a bull market generally describes an increasing stock market, a stock market that is increasing in value over a period of time. And it's generally when everybody is very, very happy with everything in their financial world because their assets are increasing. A bear market describes a stock market or a market that is declining in value over a period of time. Okay. Generally, it's indicated that if the equity market declines by 20% or greater from its high, then it's considered a bear market. From 10 to 20% is considered a correction or a pullback. Okay. So those are very loose definitions. Everybody has a little bit of a different variation of it, but those are generally pretty well accepted. Now, why does the bull, why isn't it like another symbol? Why is it that descriptor?
Why isn't it a lion or a
Yeah, why is
tiger?
it a lion? So I had an economics professor when I was in school many years ago, and he was a farmer, and he described he's one day he was crossing this he was going to round up a bull, okay, his old bull who was very cantankerous, and so he kind of cornered this bull, and this bull was not happy about being cornered, and the bull actually picked him and his horse up with ease.
It's
Okay, just
terrifying.
picked them up. Terrifying, right? And so that's why it's considered a bull market. Is bulls, when they attack, lift, they throw you up. Okay. I mean, I'm sure we've seen a lot of YouTube videos about people not being very smart in Yellowstone and the bison flinging them into the air pretty easily. And so
Yep.
that's what a bull does. They lift things up. And that's what a bull market is they lift the prices of those investments up. A bear, if you've ever seen a bear fight, they stand on 2 feet and they claw down. Okay.
Mm.
So they claw down at whatever they're tussling with. And so that is a bear market. They're attacking down. Okay. So that is, a bear is down and a bull is up.
I just had all seeing the bullfighting in Spain, right? Like that's what came to mind too, or rodeos, right?
Yeah.
When like throwing the clowns.
Yes.
Yeah, that was very when you said that, I was like, oh yeah, I've seen that image before.
Yeah. Yeah. So that's the image. That's the reason. If you're not familiar with it, it's kind of a weird. I mean, you get used to it, but it's kind of a weird descriptor. But that's the history of it.
I
Um,
like it.
Now, are we in a bull market? That depends. Depends on how you slice and dice the equity market. Right now, I will tell you the top 6 mega cap technology stocks are in a bull market. Okay, they've had an amazing run so far in 2023. Doesn't mean they can't have a pullback, because we have pullbacks all the time during bull markets. But are they going to reach their lows they set in 2022? Probably not. Probably not. So those I would consider in a bull market. What about the rest of the market? So
Mhm.
those are the top 6 and 7 stocks in the S&P 500. What
Right.
about the other 494 stocks, which are very big companies, very successful in many ways, and in depending on their business. What about them? Well, I would not consider them into a bull market. They have not yet come up to a sense, to a situation, to a price level that I would consider it to be, hey, they're out of the woods, that they can't fall back too close to their prior lows.
Mm.
Um, Again, I think we have things set up that we could be starting one. And so it's really important to consider that right now. Like last time we spoke, we talked about the narrow market breadth, when only a few stocks are driving these equity market returns higher. Is that a healthy thing? No, it's not a healthy thing. That has to narrow eventually. And it can narrow from these mega cap stocks retain, just staying at the same level while these other companies catch up. And that may be what happens in this scenario, because as the Federal Reserve pauses and possibly, again, moral suasion, may not increase interest rates again, what does that do for the smaller businesses? Well, that defines what their cost of funding is. And that's really critical for planning, budgeting, investing. And so once they know what their cost of funds is, they can then plan and budget and spend more money. What does that do? That drives earnings higher. As earnings get driven higher, so do stock prices. So again, that breadth of the stock prices would be broadening out, and they would be playing catch up to those large 6 or 7 mega cap stocks that have really led this year.
So what does that look like? Because when we talk about the S&P 500, we're talking about the 500 largest American companies by market capitalization, right? So when you just mentioned smaller companies as well. So what do we expect overall for the markets? Like if you've been in those top 6 or 7 big mega cap tech stocks, you're experiencing all kinds of gains, right? But what about, again, we just talked about the rest of the S&P 500, but then what if we look at mid caps? What if we look at small caps? What do we expect in those realms?
Yep. So mid cap and small cap stocks are very, very, very sensitive to funding of loans. Okay, so to getting bank loans, to having the cost of those loans be reasonable relative to their business. That's one of the reasons that small caps have really struggled over the last year or so, is because their cost of funding on their loans went up a lot. That is, if they could get loans, right? We've had the Federal Reserve bank lending officer survey has come out, and 2/3 of banks are increasing their credit standards. So there are going to be some smaller companies that cannot get loans. They can't refinance. They can't. So that is going to put a real hamper on their business. Now, that said, when we do see the economy slowing, inflation slowing down, the Federal Reserve pausing, that sets up, again, a really good situation where bank lending can start to loosen their standards. And that will be the key, that small caps will start to really, really generate some large returns. Small caps are generally very volatile compared to large caps, particularly mega caps. But one of the things they really do is when they start to gain, they can gain really fast and they can gain a lot. So generally, small caps have been the bedrock of innovation in the US economy over many, many years. And so I would say that's probably still in place. And so we're excited to see that leadership being taken on sometime in 2024, probably, as the cost of funds and the yields start to come in and realize that inflation is declining at a pretty rapid clip right now.
So the other place I wanted to ask about, because we touched on this a little bit last time too, is internationals. And so what does the Fed pause on interest rates? What does that mean for international stocks? Does it mean anything? Is there any correlation?
Yeah, it means something, because they pause, and now if you're a European investor who is seeking to get the highest interest rates, you're like, okay, we're at 5 to 5.25% in the United States. If this is where the terminal rate is, I'm happy for now. But this morning, the ECB, the European Central Bank, raised interest rates by 0.25% and indicated they will continue to do so until inflation is in their target range. So now, if you're a European investor, what happens? Now it's more of a fight. It was easy when European interest rates were so low relative to the United States, but now they're going to start to have that battle as to how much money do I invest in Europe with interest rates, because I know those are going to be going up, versus United States, which may or may not have any more interest rate increases this year. Again, Jerome Powell said 2 more possibly this year. My guess is he's saying that just to retain optionality, or the option to increase interest rates if inflation reaccelerates. But my guess, my opinion is is that they're going to pause because it's my belief, or my conclusion based on my analysis, that inflation is coming off pretty quickly, and there's really no need to increase interest rates any longer.
So what do you see as kind of projections for the rest of the year, given that we have, again, we've got the pause, whether it stays that way completely, or, at least we're not in this place of, we don't know how many more times there's going to be an increase, which is what we've been in for the last year and a half, like we talked about. What do you see as like I said, no crystal balls, nothing like that, but what might we see for the rest of the year?
We're going to have a lot of volatility here in the summer, primarily based around office, commercial real estate. Again, early in the spring, we had a lot of turmoil in the regional banking, with a couple of regional banks, fairly large regional banks, get taken over by the FDIC and then sold off, either their assets or being sold off to larger competitors. Well, that office CRE is still having to be refinanced, and there's roughly, from the estimates I've seen, around $300 billion needs to be refinanced because those loans are coming due.
Wow.
So if you own an office building, and let's say maybe it's not in the greatest shape, it's okay, but it's a little older, you're going to have to bring more cash in to refinance that property with your current bank. Or instead of doing that, do you sell off that property, take your cash out, and move on to another property that may be a little bit better, in a better location, or what have you, or less vacancy? So that issue is going to cause a lot of volatility because that's going to constrain, again, more illiquidity, less liquidity going into that system, less loans being done. That's going to be a problem for certain companies. Now, I do think, when I said that, the banking system overall is very healthy. They are light years away from they were in 2006, 7, and 8. So I think most regionals will be okay. That's not to say there won't be some pretty big turmoil here over the summer as that office CRE comes due. So that's going to be a little bit more volatile. However, I think that we're on a path towards inflation coming down to the target range, which means interest rate policy is going to be less hawkish or more dovish in the future, maybe, later this year, early 2024. And that's starting to set up a pretty good situation for equities to continue to rally, and to have that rally broaden out to the smaller companies overall. So I'm very excited to see that.
Awesome. Well, I think that is a good place to pause for today. And we're going to come back to especially that commercial real estate piece. I think that's going to be important over the next few months. So we'll check back in with that. And as always, if you have any questions, if anything comes up, literally, like we talked about, what is a bull market and why is it called a bull market today? If any questions come up that you want to have answered on the podcast, let us know and we will answer them here and have it recorded for you. And you can reach me at hannah@expansiveceo.com, or on LinkedIn or Facebook, and you can reach Brad. Also, where can people reach you, Brad, if they have questions?
You can reach me at B Haines, so it's BHAINES, at juncturewealth.com. Or you can look on our website and give us a call. Either way, I would love to hear from you.
Yeah, let's get those questions in. Love that. Thank you for being here, Brad, as always.
Thank you.
That's it for this episode. Thanks for listening, and be sure to like and subscribe. And again, if anything resonated with you from this episode, I would love to hear from you. Email me at Hannah, HANNAH, @expansiveceo.com, and tell me about it. And if you're ready for your greatest expansion, you can find ways to work with me at expansiveceo.com and at x2wealthplanning.com. That's X, the numeral 2, wealthplanning.com. So until next time, remember that there is enough, you are enough, and your birthright in this lifetime is to be expansive.